Hi, this is Jeng, and sometimes I hear this from people. They tell me, I don't want to buy my own deal. I want to be an LP or limited partner for life. And sometimes this is busy professionals. Sometimes this is people who are just, reaching retirement and they don't have time to go out there and find their own deals. So they just want to be a limited partner. And so in this video, I'm going to be talking about how to analyze a deal as a limited partner, sort of taking what the general partner gives you and interpreting that and seeing if that makes sense for you as a limited partner. And so remember, a limited partner is really someone, they don't sign on a loan, they don't have control of the asset, they don't find the deal, they don't receive any fees for doing the deal, but they do receive tax advantages of owning the real estate. And their job is really to find general partners to invest with. And the other thing is they have to also learn how to underwrite deals to know if it is a good deal. So that is what we're going to be talking about today. When I look at a deal, in terms of evaluating a deal, I really look at number one, the people, right? Who's going to be running the deal? Is what's their energy level, intelligence, their integrity, those types of things. Ability to adapt to situations, right? Like we're going through now, being flexible, being able to modify the business plan if needed. Number two is the property, right? So is it class A, B, C? Is it multi? Is it senior housing? Is it student housing? Number three is timing in terms of where we are in the cycle. Number four is market, where it's located. Maybe the submarket is located as well. And the fifth thing is really the underwriting of the deal, right? So what's the pro forma rents? What's the reversion cap rate? What's the debt terms? Those are the things that I'm looking at in terms of whether or not I should invest in a deal. So here's a high level look at sort of my investment philosophy in terms of, searching for passive cash flow, looking for timing of when I'm going to be investing in markets, what I'm going to be investing in, where, and then also who I'm going to be investing in. So let's take a look at a sample deal. Class C, 12 million bucks, 830,000, about 6,500 a door in capex, 2% acquisition fee, closing cost of about 2% as well. Working capital of about 300,000. So total capitalization of about $13.3 million on this deal. And the general partner is looking for about 20% override. It's a well occupied deal, and they're projecting a 15% IRR. So what I did was I just sort of dropped it into a high level model here and plugged in what the general partner gave me, right? So a lot of times if you're underwriting a deal, you might have an offer memorandum, a T12, a rent roll, a full sort of due diligence on the deal. But as a limited partner, you're typically only given like a PDF, very high level overview. So I'm going to try to plug in the numbers based on a high level sort of investment package that I received. And here we go. So plugged in sort of your inputs on the deal, the unit mix, the expenses that they're projecting, and then the projections here on the right-hand side. And that's going to feed the cash flows and the returns. So on this particular deal, once you plug that in, they're getting to about 15% IRR. So let's look at the, how they got to those returns, right? So purchase price, that's just what they're buying the deal for. Rehab is the amount that they're putting into the deal, about 6,500 a door, which is, for a B minus C deal, that's probably about average. Most of the time they're going to roll in about 5,000 a door, Fannie Mae. They're getting about 75% loan to cost, three and a quarter interest rate, 2 years IO, 30-year AM, and that's all normal. Closing costs about 2%. Working capital about 2.5%. So a lot of that's going to be for the initial rehab and then getting reimbursed from the lender. Reserves at close, I assumed about a 12% or 12-month P&I on that one. They're using a 675 reversion, which I think is pretty healthy. Cost of sale is 4%. So this is a combination of your prepayment penalty, your listing broker fee, your title cost. Sponsors taking about 20% of the deal, acquisition fee of 2%, and asset management fee of 1%. So that's what I plugged in up here. And then let's go over to the unit mix. So here is the current rent, sort of where the rents are now, right, by unit type. And then this is the pro forma rent. So they're anticipating raising rents about 20%. Here on the left-hand side, I pulled some comps. One bedrooms, they're about 848 right now, and they're trying to raise them to about 1,000. So that's on the very top end of the comp range. So I think you're gonna have to compare sort of where you think this general partner is going to take the property with that $6,500 per unit rehab, and compare it to other rental comps. Same with the 2-bed, 1-bath. It's 928 now. They're trying to take it to 1,100. So if they're able to achieve that, then you're going to have to see a significant improvement. Your quality of asset needs to be that much higher than that top level comp. So that's unit mix. Let's go to expenses. They use 3% management fee, which is pretty standard for this size deal. G&A of about 370, which is fine. Payroll they had a little bit higher, so maybe figure out what they're exactly doing on payroll. We like to see that probably 1,100 to 1,400. They're at close to 1,500 a door, but this is a smaller asset, so it's 128 units, so that might be skewing it a little bit. Utilities, T12 is fine there. Repairs and maintenance about 750 a door. Insurance about 560. So maybe check and see if there's been any previous claims on the insurance. Real estate taxes based off of 90% of purchase price, and in replacement reserves at 300 a door. So this is where it gets a little bit more interesting. So a lot of times general partners will give you only their income statement or pro forma projections for the next 3 years, let's say, for example. And then from there, you sort of have to back into how they got there, right? So I took their projections and basically put them over this one to match in the model. So here's the property cash flows in box 5. And the way I got to those is basically mirroring the general partner's property cash flows. And so the way I got there was essentially I had to bring economic vacancy from 25% all the way down to 11%. And I had to bring other income up about 20% each year from the original 215. Everything else, rent growth of 5%, 3% was still pretty high. Rent growth was still pretty high to me. And then expense growth, they kept at about 3%. So we'll talk about those projections in the scenario analysis going forward, but that's sort of how I backed into it. In terms of returns, 5-year total return based on these projections is about a 15% IRR, cash on cash about 10%. And, let's look at sources and uses. So you can see they're buying the deal for about 93, 94 a door, rehab about 6,500, closing costs, which is sort of like your loan origination, title costs, things like that. It's 240, working capital 300, reserves were about 500,000, and they charged a 2% acquisition fee. So all in, you're about $14 million to close. And so they need to raise about 4.6 million. So that's how much they had in their offering sort of package going out. That's how much they were trying to raise. So let's dive in a little deeper. So property cash flows, once you put in those items in terms of projections, this is what you got. So I think some of the key things to look at is sort of their other income forecast was going from 215 to 310. So that was driven a lot by, they think they can rub back a lot of the utilities that they currently are not. And then also they're going to drive this vacancy number, this economic vacancy number down from 439 to 209, essentially by starting with a high rent and then burning that off, or burning the loss to lease off. So that's really driving the NOI from about 600,000 to $1 million. So it's a big increase in NOI, and that is how they're going to, really achieve sort of the value add piece of this deal. In terms of net sales proceeds, they have them, selling the deal for about 129 a door. So remember, if you go back here, they're sort of all in for 110 a door total capitalization, and then they're selling for 130 a door in year 5. And then in terms of cash flow, average cash on cash about 10%. It's a little bit skewed because of the reserves coming back to you, and then the return of about 15% IRR, which is pretty healthy in terms of overall return. Sponsor is going to make about $1.8 million, combination of asset management fee, cash flow to the sponsor, sales proceeds, and acquisition fee. And the loan starts at about 9.5 million, 2 years of interest only, and then goes to start amortizing. This is the overall return again. So let's keep that in mind. So based on the projections of the general partner, you're expecting about 82% return total, and then about a 15% IRR net to the passive investor. So let's look at some scenarios, right, and see if maybe there's some upside in this deal, maybe there's some risk in this deal. Start with the reversion cap rate. So they used 675 for sort of a B minus deal in Dallas, B minus C deal, and so I thought that was probably fine. If cap rates stay the same or sort of go down from here, could be some upside in that reversion cap rate. So 625 could double up your money there. If it goes to 725, it goes to 63%, still a healthy IRR of about 12%. So I think reversion cap rate, I think, is fine. 675 works. In terms of loss to lease, so this is where it's very tricky. So they set those pro forma rents high and sort of burned off the economic vacancy, right? So they started at 25%. So let's go to the model. So they started here, economic vacancy of 25% based off of your gross potential of 1,758, which is basically just your pro forma rent times 12, right? So they started at 25% and they burned that down to 11%. At the same time, they're increasing other income, right? So you have to watch that other income. They increased it by about 20% each year. So, number one thing is, first, are these pro forma rents achievable at the same time of bringing that other income up? So that I think is the biggest question. Let's say you weren't able to burn that loss to lease, you had to keep giving concessions, then you might only stabilize at 20%, which could hurt you dramatically, right? So that is the crux of the deal: is, can I achieve those pro forma rents without giving concessions? And if you do hit that 11% economic vacancy, then you get to the 82% total return, 15% IRR. But if you don't, you are in trouble, right? So 24% total return. If you come down to 15%, you get to a 52% return. So, depending on where you think your level of comfort on that burn off of loss to lease is very important in this deal. In terms of other income growth, so they were forecasting of growing this about 20% per year. And this is really by rubbing back the utilities. So right now they're not doing all the rub back. So that's what they're going to come in and implement. But sometimes that can be a challenge if you're putting in not only the rental income growth in terms of the top line rent, but then also trying to rub back at the same time. So just make sure the comps in that market are doing the same thing and that you are a comparable quality. Base case, they had 20% growth in years 2 and 3 on the other income. But if you did 10%, you did 67%, and only 2%, which is sort of your standard other income growth, you get to about 57%. So that one did not drive it as much as I thought, just because you're growing a smaller number. Definitely this burn off of loss to lease is what was driving a lot of the value add piece on this deal. And so my background, born and raised in Houston, went to school at UT, was an underwriter for 8 years at G Capital. In the last 5 years, I've been originating multifamily debt as a mortgage broker and invested in close to 6,000 units across Texas. And so if you like this video, definitely subscribe to the channel, like the video, join the email list. And if you want a term sheet on a deal, send me an email with the T12 rent roll OM. Or if you want to review a deal, let's say you got an investment package, send it over to me. I'll review it, give you some comments on it, and go from there. So definitely set up some time to talk with me about buying, selling, or refinancing your next multifamily property. Thanks, guys.